Hi. Normally, we've heard that all the assets typically trade on three kind of platforms. Okay, we're going to understand all these three platforms to do with currency trading in India. The first platform on which currency can trade is called the spot market. Another platform where it can trade is called the forwards market. And the third where it can trade is called as the futures market. We're going to come up with multiple videos where we are going to explain to you exactly how spot markets operate, forwards, futures, what they are, and ultimately we will try and understand something which actually played a major role in currency depreciation, which is called as non-deliverable forwards. So let me first start with helping you understand what is a spot market. Say for example, you intend to go to the US for further studies, or you just want to go to the US for a leisure trip. So when we go to the US, we'll have to spend in the US their local currency. Their local currency is a dollar. But in India, do we possess enough dollars? Or do you currently have a lot of dollars which you can go to the US and spend? The answer is normally a no. So the first thing you'll have to do is make sure that before you go to the US or on your way to the US, you have enough dollars that you can spend there. Now, how do you, as a resident of India, get enough dollars to spend in the US? So the first thing you would want to do is you would want to convert the rupees that you currently have into dollars. Now, how do you convert rupees into dollars? On the airport, you all must have seen a lot of people who have offices saying currency converters. For you to convert your currency from a rupee into a dollar or a dollar into a rupee, you need to go to someone who's called an authorized dealer. Authorized dealer. The biggest authorized dealer in currency is a bank. So, whenever you want to convert your rupees into dollar, just go and meet a bank. So when you go to the bank, tell the bank that you want to convert your rupees into dollar. The bank will quote you a rate. Let's say the rate that the bank quotes you is $1.62 rupees. It is trying to say that if you give the bank 62 rupees, the bank will give you $1. So if you want $100, you will have to give to the bank 62 into 100, 6,200 rupees for you to get $100. It can work inversely as well. Now, what do I mean when I say it can work inversely as well? You've come back from the US, you have with you $10 remaining, which you could not spend in the US. Now you would want to convert your $10 into Indian rupees. So what do? You again go to the bank. The bank quotes you a rate. Let's say the bank is quoting you a rate of $1 equal to 60 rupees. So what happens is for $1 the bank is willing to pay you 60 rupees. So if you give $10 to the bank will return to you 600 rupees. This transaction that you are doing with the bank is called the spot market. Now that we've understood what's a spot market, let's try and understand what's a forward market for currencies. What's a forward market? Say for example, you are an IT company and you've been serving a lot of clients in the US. You are expected to receive $5 million next year. You are expected to receive $5 million next year. At the current given rate of dollar in the market, you are expected to receive 5 million into 60, where we saying you are expected to receive 3 crore rupees. You have a fear that tomorrow, if this $1 falls down to 50 rupees, instead of 3 crore, you would receive only 2.5 crore, which means that though your business is stable and you are supposed to receive the amount of money that you are actually supposed to receive, which is 5 million or 5 lakh dollars, but the currency fluctuation could spoil the party for you. So what do? This is a case of an exporter. As an IT company, I export softwares. So I'm talking from the point of view of an exporter, where I am anticipating that if the rupee appreciates from $1.60 to $1.50, I might have a problem. So what do? Now I would want to hedge my currency risk. So I approach the bank. I tell the bank that I'm supposed to receive $5 million or 5 lakh dollars the next year. I want to sign a forward contract with you at the current rate of $1 equal to 60 rupees. Now what does this mean? This means that if the bank signs this contract with the IT company, irrespective of $1 becoming 50 in the future, whenever $5 million are supposed to be received, it will be converted at $1 equal to 60 if the forward contract is signed, which means that if the bank and the IT company for some reason sign the contract at $1 equal to 60 rupees, and tomorrow $5 million are supposed to be received, where the actual rate quoting in the market is $1.55. If this forward contract was not in place, the bank would have paid 5 lakh into 55, but because of this forward contract at $1 equal to 60, when the bank receives 5 lakh dollars, it will have to pay to the IT company at 60 per dollar because of this forward contract. Okay. For signing such a forward contract, the bank typically receives a fee from the exporter. The fee is normally a percentage of the amount of dollars or the rupees that the exporter wants to hedge. So let's say if 5 lakh dollars is what the exporter is looking at hedging, then the exporter will have to pay 5% of 5 lakh rupees to actually go ahead and do such a transaction, which is close to $25,000. Don't go on the exact numbers. This is just to help you understand how does the deal take place. This entire deal is called the forward contract, which means that the bank and the exporter are deciding the price of the dollar, $1.60 today, at which they are going to transact in the future, irrespective of whatever the current market price then would be. Which means even if it is $1 equal to 55 rupees, then after a year when the 5 lakh dollars are to be received, still the transaction from the bank side to the IT company will happen at 60 rupees. And even if $1 becomes 50 rupees in the market, the bank will pay as per the 60 rupee contract, which means 5 lakh dollars will be converted at 60 rupees only. But let's say even if $1 becomes 65, this situation is going to be a little beneficial situation for the bank, Because when $1 becomes 65 and the transaction takes place as $1 equal to 60, in this case also the $5 million to be paid will be paid at 60 and not 65. This is a case of a forward market where an exporter is signing up a forward contract. Why is it called a forward contract? Because you are deciding the price of the asset dollar today, $1 equal to 60 rupees, at which you are going to do transaction in the future forward. Irrespective of whatever the price the market quotes, the transaction will happen at the predetermined price today for the number of years or for the time that you've signed the contract for. A similar case can be understood for an importer. Let's say I am someone who's in the business of importing crude. Now I know that one barrel of crude today costs me $110. $110, and with the given $1 equal to 60 rupees situation, for me to import one barrel of crude, I have to typically pay approximately 6,600 rupees to import the crude. But if tomorrow one barrel of dollar is still 110, which means the cost has not gone up for crude, but if $1 becomes 70 rupees tomorrow, now for the same $110 barrel worth of crude, where the price of the crude has not gone up but our currency is depreciated, we will have to pay 7,700 rupees, which means though the price of the crude is constant at $110 a barrel over here as well as over here, but because of our currency fluctuation, crude has actually become expensive for us. Which means if I can take care of the currency fluctuation, I can actually save on paying higher costs for the crude. Which is why me as an importer will sign a contract with the bank again, saying irrespective of wherever the dollar moves, we will transact at $1 equal to 60 rupees. Which means, say for example, for me as an importer, I have to pay $10 lakh at the end of the month to Iran from where I am importing crude. So I will sign a contract with the bank for $10 lakh for a month, which means that at the end of the month, I will pay to the bank 10 lakh into 60, which is 6 crore. I will pay to the bank 6 crore rupees, and bank will give me $10 lakh, which I will pay to Iran from where I am importing, irrespective of whatever the dollar price in the market is. Which means if $1 was 70 rupees at the end of the month, if the contract was not in place with the bank, I would have had to pay to the bank 7 crore rupees to get $10 lakh. But because of the contract being in place, I'll now only have to pay 6 crore rupees to get $10 lakh or $10 million from the bank. The case also works the same way. If $1 was at the end of the month 50 rupees, now the transaction will not happen at 50 rupees because our deal is at 60 rupees. So if the forward contract was not in place, I would have had to pay less. How much would I have had to pay? I would have had to pay only, I wanted 10 lakh dollars. Current is $1.50. I would have had to pay only 5 crore rupees. But because of this forward contract between me and the bank, which is $1 equal to 60 rupees, in this case also I'll have to pay 6 crore rupees to get $10 million or 10 lakh dollars. So a forward contract is nothing but a contract between two parties, bank and either an importer or an exporter, where they decide the price of the asset, which is in our case $1 equal to 60 rupees, for 1 month, 1 year, at which they are going to transact in the future, where actual rupees will be given to the bank and dollars will be received from the bank, or actual dollars will be given to the bank and actual rupees will be received from the bank at a predetermined price in the future. This is called a forward contract.